online shopping fast becoming the new norm, it shouldn't be a surprise that the number of big box stores is dwindling. According to Coresight, a global advisory and research firm, the U.S. is currently facing more store closures than in the past. Despite the loosened COVID restrictions, more and more stores are closing. According to new data by Coresight Research, more than 8,700 stores have closed since 2020, and another 1,400 are expected to shut down this year. One thing for sure is that more shops will close in 2023 as a recession looms. In this video, we dig into 20 big box retailers closing down stores right now. Please support our channel with a thumbs up, and don't forget to subscribe to our channel. Number 1. Burger King. Burger King has experienced a decline in its business for several reasons, backed by supporting facts and statistics. Firstly, changing consumer preferences towards healthier options have affected the fast food industry, including Burger King. According to a report by MPD Group, fast food chains that offer healthier alternatives have seen increased customer visits, while traditional fast food chains like Burger King have struggled to keep up. Secondly, the intense competition in the fast food industry has impacted Burger King's market share. As reported by Forbes, McDonald's and Wendy's have been successful in capturing a larger share of the market, leaving Burger King with a smaller slice. Furthermore, Burger King has faced challenges with its marketing and advertising strategies. According to Statista, the company's advertising spending has declined from $497 million in 2019 to $349 million in 2020. This decrease in marketing investments may have affected brand visibility and customer engagement. In addition, the pandemic has impacted Burger King's operations. Many of its restaurants face temporary closures, limited dine-in options, and shift towards delivery and takeout. This disruption in operations has negatively impacted sales and profitability. Lastly, consumer perception and brand reputation also play a role in Burger King's decline. According to a 2020 Harris poll, Burger King ranked lower in brand reputation compared to its competitors, indicating a potential loss of customer trust and loyalty. Number 2. Chick-fil-A. While Chick-fil-A is a walk-in shop, you'll have to look for another store to enjoy your favorite food. A beloved chicken shop famous for chicken sandwiches and fries, Chick-fil-A is planning to close some of its restaurant and retail chains, making it lose its first-ever location. Chick-fil-A prices have witnessed a noticeable increase over the past year. According to a recent analysis, the average price of a Chick-fil-A sandwich has risen by approximately 10%, from $3.65 to $4.02, reflecting the impact of inflation and rising food costs. Number 3. Starbucks. One of the world's biggest coffeehouse chains, Starbucks has announced its plan to close up to 500 of its stores in the U.S. The store has explained that it's doing this to focus on curbside and drive-through pickup options, something you can look forward to. The president and CEO, Kevin Johnson, said that the store would have a surplus at the end of its transformation. He further said that they expect to have over 850 new stores with an average of 800 store closes across the country. Number 4. Amazon Go. This year, Amazon Go announced it will close 8 of its 31 stores in different locations. Although the company has said no other stores apart from the 8 risk closure, it's not yet clear when this activity will end. The latest closures came only a year after the store stated it would close 68 of its stores across the UK and the US. In addition to the 21 Amazon Go stores that will remain, there are 2 locations in New York that the brand shares with Starbucks. More recently, the company has been trying checkout-free technology at some Amazon Fresh stores and Whole Foods to support Amazon Go locations. It also explained that it remains committed to operating all the remaining shops. Number 5. Bye Bye Baby. Bye Bye Baby is one of the store's closing shops in 2023. The shop comes as a package deal with the closure of the remaining branches of the parent company Bed Bath & Beyond Inc. According to a large statement posted on the company's website, the store would begin liquidation sales for over 120 stores. Although the dates are yet to be determined, the closures are expected to end on June 30th. The company has confirmed that it's still operating due to a $240 million line of credit. As the company veers towards the official closing date, prices of goods have continued to drop. So if you're planning to make a purchase, this is the time to take advantage. Number 6. Best Buy. Despite an increase in online sales, Best Buy has no desire to subsidize its stores as it plans to close more stores this year. With some traffic shifted back to its store channel in 2022, it's believed that much of what happened in the previous years will be permanent. In an earnings call in February 2021, Best Buy said that it's planning to close more stores as its activities are winding down. According to its 2022 annual report, it plans to close all stores by 2025. While this is going on, the company plans to remodel 2 of its stores and implement 8 store remodels. The revenue has also gone down by roughly 10%, something which the company attributes to ongoing inflation. Number 7. Macy's. Macy's closed 36 of its stores in 2021, with 4 more stores expected to be closed in 2023. In its fourth quarter and 2022 earnings report, it stated that it intends to close even more branches. While announcing the closures, they claim that they want to experiment with opening smaller, trendier stores called Market by Macy's. Jeff Gannett, the CEO, explained that the business has deteriorated due to the pandemic influence since stores were closed by the government for some time. Number 8. Fossil. After losing over $96 million, Fossil Group, a company that designs watches and handbags, such as Zodiac watches, intends to close some of its shops. The company intends to reduce its stores by 20%. According to Yahoo, the company plans to shut down 75 of its retail locations due to losses caused by the pandemic. The new report also indicated it made losses to the tune of $96 million over the past year. However, it believes that there will be an increase in digital sales in the long term that will accelerate its shift online. Number 9. Disney. Disney, your mega brand that makes money from different sources such as movie production, retail, theme parks, and streaming services, is also planning to close shops. While online shopping cast a dark spell on the company persevered until the arrival of the pandemic. For instance, in 2021, the value of its assets dropped from $2.6 million to $1.1 million. This effect was even felt in the financial statements of the parent company, which incurred a loss of $0.4 billion due to severance costs related to the closure. The company has now announced that it will focus on its digital shop and push a greater integration with the Disney Parks app and other social media platforms. Number 10. Toys R Us. Toys R Us is closing some of its stores due to tough economic times. After filing for bankruptcy in 2018, the company started shutting down many stores. While the company opened 2 stores in Texas and New Jersey in 2019, it permanently closed both locations last year. Furthermore, the company faced significant challenges due to a substantial debt burden incurred as a consequence of a leveraged buyout facilitated by private equity firms. Moreover, WHP Global, a multinational brand management company, acquired a majority stake in the company, with plans to strategically reopen additional locations in the future. Number 11. JCPenney. JCPenney is a department store that has existed for over 120 years, but has suffered financial difficulties over the past few years. After enduring years of declining sales, the store filed for bankruptcy in 2020 and plans to close 30% of its locations. JCPenney has been struggling with reduced profits and sales for years, as most customers move from traditional department stores. They have also faced stiff competition from retailers like Amazon, Walmart, Ulta, and Sephora. For the fiscal year 2020, it reported a loss of $1.7 billion compared to the $268 million that it reported in 2019. This was attributed to the pandemic, which dealt a major blow to the stores by forcing lockdown measures. While mall owners Brookfield Asset Management, Inc. and Simon Property Group stepped in to acquire the company and rescue it from its ruin, the closures are still going ahead. The retailer shut 170 of its stores last year and plans to close another 90 stores this year. Number 12. Gap and the Banana Republic. Gap and Banana Republic have announced on their website that they'll close over 50 stores this year. They further plan to close 350 of their stores across America by the end of 2023, as they slowly adapt to an increased demand for online shopping. The Wall Street Journal reported that the company experienced a challenging year in 2022, facing a decline in sales of more than 5%. For instance, at the end of 2022, there were 912 total stores, with a sharp decline from 1,216 stores that were there in 2019 before the pandemic. While several stores are closing down, the brand's other stores in Athleta and Old Navy are opening up in different locations. Number 13. Christmas tree shops. With Christmas tree shops intending to close up to 10 branches, you may not have a lot of options when it comes to decor shopping for the next holiday season. According to its website, the company currently has 83 stores and has asked the courts for permission to close 10 of its non-performing stores. The stores facing closure will host several sales to clear the goods by offering customers up to 30% off. While the company estimates its assets to be between $50 million to $100 million, its liabilities were reported to be between $100 million to $500 million. Number 14. Christopher & Banks. Founded in 1956, Christopher & Banks is a women's apparel retailer that mostly deals in women's clothing. The company filed for bankruptcy in January 2021, indicating its plan to close a huge portion of its stores. During this process, the company acknowledged that its earnings have been significantly impacted by the ongoing pandemic. According to the CNN database, in May 2021, the company took a loan of $10 million from the Paycheck Protection Program to cushion itself, but has now decided to close up its operations due to the financial difficulty which resulted from the pandemic. Number 15. Fry's Electronics. After operating for over 36 months, Fry's Electronics decided to close up its operations by shutting down its online store completely. Founded in Silicon Valley in 1985, it deals in hardware, software, toys, and cosmetics, among others. According to a statement published on its website, the company said it decided to shut down completely because of the challenges brought about by the pandemic. The store started the process of closing shops in February 2021, and it's unclear how many closures will be made. As the retailer clears its stock, this is your last chance to grab hardware, toys, cosmetics, and any other thing you need from them. Number 16. Tuesday morning. Tuesday morning, your discount home goods shop is expected to close 200 of its remaining stores. The shop first filed for bankruptcy in May 2020, during the peak of the pandemic. Currently, it has closed up to 500 of its stores. The store announced on its website and Facebook page that it has started winding up with 30% discounts on its products. This means customers had until May 13th to use their gift cards. The company's current count of 200 stores represents a significant decrease compared to the pre-pandemic era when it had 700 stores. One thing to note, though, is that it doesn't sell its products online. While Tuesday morning stores may have managed to stay afloat in the past few years, the company has again filed for bankruptcy and is planning to close all remaining stores. Something quite sad, isn't it? Number 17. Target. Target, a comprehensive retail store, offers a wide range of products, including shampoo, groceries, and fashionable attire, allowing customers to conveniently fulfill multiple needs in a single visit. Although the retailer has around 40 upcoming openings, it intends to close 4 of its branches this year. In an annual report filed last week, it intends to open 20 new stores and remodel 70 locations this year. The company has now joined several other stores that have been closed due to the effects of the pandemic. Number 18. PaperSource. PaperSource is a greeting card company that filed for bankruptcy in 2021, hardly a year after carton cards and papyrus went into the recycling bins. Currently, the company plans to close up to 11 stores while trying to assess other potential locations and securing rental concessions, according to documents filed in court. The company had bought 30 new stores from Papyrus just a few weeks before the pandemic came in 2020. And by the time it filed for bankruptcy, it had 158 stores, 1,700 employees, and $100 million in debt, according to NBC News. Number 19. Steak 'n Shake. Steak 'n Shake indicated in a report in March 2023 that they will close 41 of their stores to reduce the total number of their stores to 493. While Steak 'n Shake had 506 restaurants in 2022, this was a reduction from 536 the year before. This is the 4th straight year that the company has closed more restaurants and reduced its units by 19%. A sweet and salty chain company which hasn't posted a good record in the past few years. If you love good food, you'll miss these stores. Number 20. Goodwill. While struggling customers could take advantage of discounts on books, toys, and clothes, most people are increasingly shunning secondhand items. Coupled with the pandemic, Goodwill has struggled financially in the last few years. This has caused the company to close 8 locations and lay off their employees in the San Francisco Bay Area. However, the company said they will continue to support their employees and fulfill their mission in their remaining stores and facilities. But if you're a fan of the brand, you'll be affected. With the economic situation being ravaged by so many losses, consumers are increasingly losing stores they've depended on for several years. This is especially true for struggling stores that don't stand a chance in this unforgiving environment. You can rest assured many other big box stores will follow suit in the coming years. The situation is so bad that analysts have predicted that by the end of 2023, the big box shop's footprint may be reduced by over 20%. Now is the time to take advantage of the deals while you still can. Thanks for watching. Please like, subscribe, and comment below, and watch this one as well.